Good morning.
Good morning.
How's everybody?
Good morning, Jen.
So as we know, the lending world is not always the most exciting, but we make it exciting. And I have Scott Quinn here with Angel Oak, and he has some really exciting products for investors, self-employed, and he's going to give you all the ins and outs on them to help you capture every single deal going into the spring season with your buyers. And after we go over the loan programs, we'll open it up for Q&A if you have any questions.
Thank you, Jennifer. Good morning, everybody. Yes, so I know the spring market, again, Scott Quinn, start there. Scott Quinn, Angel Oak. So as Jennifer mentioned, spring market is just about upon us. As soon as this weather breaks, it's going to get pretty crazy. Let's hope. I also have heard anecdotally that inventory, show of hands, is inventory still down, do you think? Is that correct?
In certain price range.
Certain price ranges, sure.
Yeah.
So every buyer, seller is critical to you guys. And as Jennifer mentioned, we have different products than your standard conventional FHA, USDA. My company doesn't do any of that. Now, we've partnered with Jennifer and Motto so that she can expand her offerings to you guys. And that's exactly what we do. We don't provide the financing for your W-2 borrower. Everybody in here, I assume, is a self-employed realtor, correct? Right. What we offer are loans for folks who, for instance, can't prove their income or play the game, let me put it a better way. They play the game that Uncle Sam has set up, and you write everything off if you've got a good accountant, which is fantastic. Saves you guys a lot of money every year. The only problem comes when it's time to buy a house, right? Now you're not showing the income necessary to buy the house that you want. Certainly you qualify for something. If you've made 250 grand but you're only showing 50 grand, well then you're going to qualify for a house that you can afford at 50 grand. But really you're making 250 grand. And in fact, those higher valued homes, you're talking in the $1 million range or higher. And by the way, being non-QM, I'm not limited by the loan limits of the counties, by conventional jumbo, FHA. Those don't come into play with me at all. My maximum loan amount is $3 million. That's a jumbo. And I can do that to 85% LTV with bank statements. And I'll get into the bank statements a little bit more in a minute. I can go to 90% to 2.5 million. That's the jumbo that we live in. You're calling me about a $700,000–800,000 deal. I know that's considered jumbo in the Fannie land. That's just a normal deal to us. Because self-employed people like yourselves make way more money than they show in their tax returns. And they want to buy a bigger house because they know they make more money. That's what the bank statement program can do. You've taken your $50,000 a year borrower per the IRS and just exponentially increased their buying power. The people buying those big time houses are typically not W-2 salary borrowers, unless they're both working for the federal government, and there are plenty of those folks. But those bigger houses are typically purchased by people who are self-employed. Wonderful if you can get them qualified through a conventional method, because being non-QM, my rates are higher than your standard Fannie Mae deals. Not a lot, depending on the nature of your deal, but they are definitely going to be higher. I'm not a long-term solution. Not a long-term solution. The bulk of the deals we'll close will be a 5/1 arm, because whatever the circumstances are that you're bringing these deals to me and Jennifer regarding their circumstances are short-term problems. I can go to 90% with bank statements down to a 660 score 2 years out of a housing event, foreclosure, short sale deed in lieu, bankruptcy. So let's say you've got a borrower who had a bankruptcy 2 years ago, and they're self-employed. Well, the bankruptcy will season from Fannie's standpoint in a couple years. So during that 2-year period, while they're seasoning their bankruptcy to Fannie Mae standards, they're also going to start filing their tax returns. Yeah, it's painful for a couple years, but if it makes a difference to them, it means more to them to have a lower rate, that's how you handle it. Again, not a long-term situation. They're either going to season their credit issue, or they're going to start filing their taxes. Or not. It's up to them, but that would be my strong recommendation, because otherwise, you're not selling them the house. They're going to continue to rent. What's the benefit of renting? Exactly. Nothing. This way they're gaining equity. They're homeowners now. You get them in a house, refi out of this in a couple of years, everybody wins. These are wonderful programs, and I'll tell you what, guess who we do a lot of loans for?
Real estate.
All of you guys. You're self-employed. And if you're doing it right, you're not claiming your income. And that's the purpose of the bank statement program. For realtors, we'll use your personal statements. If you have a business account set up, great, we'll use those. But typically you don't. And that's fine. For business owners, like the broker owner, we can use her business. You're the broker owner. We can use your business statements. We'll take a percentage off the top of those deposits. That's for any business owner. As long as they own the business 100%, we can use business statements. And boy, you want to talk about buying power from business. Staggering the qualifying income we see. $50,000, $100,000 often per month. How about that buying power? And they want to buy a big house, which means pretty good commission for you guys, which is what we're doing this for. Now that being said, the bank statement's by far the biggest product we're seeing in the marketplace right now. There are others. On the back of that flyer, if you're looking at the bank statement flyer, on the flip side of that, I'm not going to get into all those programs. I do want to hit on the third one down first. That is our non-prime housing event program. We will actually do, please do not hang up on the borrower if they told you they had a foreclosure last week and they want to buy a house. We can do that deal. Now the trick is, if they had a foreclosure in the last year, 80% max LTV. So they have to have 20% down. The rate's going to, you want to talk about brutal rates. Yeah, the risk associated comes at a premium.
What's the rate on something like that?
It's going to be in the 9s on a 5-1 arm. It's a short-term proposition. They're going to continue to rent. How much is that costing them? What's the equity position they're going to get, even at 9.5%? The job is get them in the house. They still have to qualify. They still have to meet my DTI requirements. So understand that yes, initially it's going to be a little brutal on them in terms of the rate, but it is what it is. They want to buy a house and they had a foreclosure last week, you're darn right there's a risk associated with that. We're going to charge accordingly. But we can do that deal. Don't hang up. Let the borrower make the determination if that rate is too high. Because we can close that borrower. Now for the first 2 years of a housing event, foreclosure, short sale deed in lieu, bankruptcy, it's full doc only. So that's where the first two on that flyer come into play after 2 years, and in fact the first one is my platinum where the pricing is even better, that's 4 years. But that's where the bank statement products lie. When we've talked about the bank statements, I'm going to move you down the third from the bottom, the investor cash flow. Anybody in here also an investor themselves? Anyone? Oh, no? A couple of you. So, the same problem you're presented when you're trying to buy your own house, the same deal when you're trying to buy an investment property. We offer programs for investors that do not require any income on the application, no income in the file, and in fact, no employment on the application or in the file. It is a no income, no employment investment purchase or refi. You can go to 80% on a purchase, 75% cash out. Now, I know some of you have been doing this for some time, meaning back in the 2000s, when it was the Wild West, frankly, when all you needed was a 580 score, you fogged a mirror and signed the docs, you got a loan. Literally. It is not your dad's non-QM anymore. Since 2015, there have been over 11,000 non-QM only, non-QM loans, like the ones that you're sitting in front of, securitized, meaning they've been sold on the secondary market on Wall Street. Over 11,000 since 2015. Of those 11,000, eight have gone south. That is a 0.000, 3 zeros and then a 7. Fannie Mae has lowered their delinquency rate to just under 1%. They're at about 9.94. We're crushing Fannie, and FHA has become the subprime lender of the day. We do require skin in the game. I do have a 95% loan, no MI. The rate's kind of rough on that one. 4 years out of a housing event. I can go to 1.5 million on that. But the bulk of what we'll do is at 90%, meaning got to have some skin in the game. That's the real key to the success of these products, is skin in the game for these borrowers, not 100% financing. So that back to that investor cash flow, if you're thinking an investor at 80%, the key to that product is the monthly rent has to cash flow, has to cover the mortgage payment, the principal, interest, taxes, insurance, and the association dues, if there are any on the property. So the PITIA has to be covered by the market rent per the appraiser on a purchase, or I can talk about using the lease on a refi. But as long as it covers, if my monthly rent is $1,000 and my PITIA is $1,000, we're good. 660 score, we'll close in an LLC. They have to own a primary. 660, own a primary. Those are the two main considerations. I have a trade line requirement, but these are great products for folks who can't, again, prove their income. Yes?
What if you want to make your primary an investment, buy another primary?
Yeah, you can certainly do that. Now you can't, technically, you can't go no income, no employment. I actually do have a no income, no employment owner-occupied purchase. I'll get into that in a minute. But by and large, that's a bit of a unicorn borrower. But by and large, that's absolutely fine. We use 75% of the verified, the lease on their current primary against their current mortgage payment. I can't give them any more income, but I can certainly wash out the payment. And that's just fine. Do that all the time, frankly. All the time. I'll tell you though, with bank statements for self-employed folks, oftentimes, and because if I'm getting a lease, I need an additional 6 months reserves on their current primary. And sometimes cash can be tough to come by because I need 6 months reserves on my subject as well. So now we've just basically made it 12 months reserves. On the bank statement deals, oftentimes I don't need a lease because I can include that current mortgage payment and it's covered in my debt ratio because there's that much income for self-employed borrowers sitting in their bank account. So that goes off the table. Foreign nationals, second from the bottom, there's a ton of those up and down this 270 corridor. No I-10s, please no I-10s. They have to have proper visa to be in the country. B1, B2, H2, H3 is typically what we see. But most folks think they can't get done because they're not U.S. citizens. I'm not asking for U.S. Income information. No tax returns, no W-2s. I will need letters from their home country's employer, accountant if they're self-employed, and creditors, no credit report required. 75% LTV, it's a very easy loan as well. Don't turn those borrowers away. And lastly, that asset qualifier, I just called it a unicorn borrower. I'll tell you what, somebody had a business that they sold last year, and they don't want to, and they could actually buy the house probably for cash. This is a way for them to get financing without, and because they sold a business and they made millions of dollars, they haven't been working. I understand that. We understand that. No income, no employment, as long as they have the assets to cover my loan amount, I'll go up to $3 million on that deal. The loan amount, 60 months of their monthly consumer debt that we would have used to calculate a debt ratio, and 6 months PITI. As long as we have those funds covered after closing, no income, no employment.
Did you say 60 or 6?
6D. 60 on the consumer, monthly consumer debt. So if they've got $500 a month, 500 times 60 is what they're going to need to have in the bank, essentially, along with the loan amount.
Retirement funds work for that?
Yes, they do.
Okay.
The list is short, frankly. Retirement funds, IRAs, stocks, bonds, mutual funds, 401ks. We'll use 401k, 50% of that, and bank funds, liquid bank funds. That's about the list. But it's a doable deal for somebody who can't prove their income and has a bunch of assets. And the rates are actually pretty good on that program. We go down to 75% LTV, and you need a 700 score for that. Because of those two things, it keeps the rate down pretty good. Again, don't tell your borrower you need to come back to us in a year after you've seasoned whatever issue you think they have. Give Jennifer a phone call. She and I correspond all the time. We will get back to you with an answer quickly, I promise that, and let you know if we can do your deal. Because this market, we expect it to be busy, but with the inventory low, that's going to impact everybody. Each borrower is precious. Please, please call Jennifer. You guys have any questions? Sorry. Yes?
I have one, kind of unrelated. I know someone that owns her own home, she's self-employed, and she's behind on her mortgage payment.
We don't bail anyone out. They have to be current for us to do any type of refinance, number one. And when we're talking about, that would fall into that third one down, that non-prime.
Yeah.
And we needed, when I gave you that example, or the statistic about 11,000 and only 8 have gone south, we're very particular about who we lend to. You need to pay me back. And if you're having a problem right now, why would my refinance save your butt?
Well, let me finish the question.
Sure.
She has about 200,000 in equity in her home.
Okay?
What do you do for somebody like that?
She needs to be current.
But you don't have a loan where people can
She
borrow
has to be,
from their equity?
she's in trouble. Why is she in trouble? That's the question I will ask. And if you can see it. When somebody's, the type of borrower we're looking for in that circumstance, they're doing just fine. They have a life event, a health crisis,
Right.
job issue.
That's what it is, a health
Yeah, and that's
crisis.
not unusual. A marital issue, that's another big one that we see a lot of. All those things, you see it, credit's good, issue, they're out from under whatever circumstance they are. Once they've gotten that issue behind them, that's the kind of borrower we're happy to lend to. She's currently in a situation right now that is not resolved. We're not stepping in to resolve her mortgage issue when she still has her health issue. And I know it sounds callous and unfair, but we need to lend to people who are going to pay us back. It's that simple.
So she could sell her house, get the equity,
I have a
and then
feeling she
get a
doesn't
loan
want
for
to
the
sell
next
her
one?
house, would be
Oh,
my guess.
she's gone into a sales situation. It was like a shark feeding frenzy.
What?
Her place was listed for sale
Oh, okay.
and went below market value. Yeah, it was a bad thing to see. I wasn't involved in it, I saw it from a distance, but I was wondering what could I have offered her? If I see that situation again, how should it be handled?
Give
So
Jennifer a phone call. and let's see what we can do. We'll pull a credit, take an application, we'll see what the circumstances are. We'll see where she is in her crisis. We'll see where she is with the mortgage. Again, the mortgage has to be current for us to touch it. If she's in trouble, we're not going to put ourselves in trouble. Let me put it that way. That's really the bottom line.
So she
Look,
ended up
and
selling.
here's the thing, I'm gonna say no, quickly, because that's as important as a yes to you guys. Because you need to move on. If it's not something that's doable, I think you learn after doing this for a while that you don't wanna sink your teeth into something and not let go when it's not a deal.
Mhm,
And that's part of my job, is to let you know it's not a deal.
mhm.
So she did sell her property,
It's under contract.
so she will have equity then, so now she could go ahead and purchase.
Well, that's what I'm wondering now, is what is the right way to do that, you know? Does it make sense for her to take that equity that she gets after she closes and buy another property?
How is her health?
That's unknown to me.
Again, that's gonna be a key component for us. I mean, if she's having issues getting to work, which would be my guess from what you're talking
She's
about.
self-employed.
She's self-employed, so she can't really work, but she's got a health issue, it makes it difficult, right?
Right, exactly.
So she's not generating income. That in and of itself could be a problem in terms of verifying her income. She needs to get back on her feet. So she sells the house, maybe she rents for a little bit, gets her health squared away. She'll have some money in the bank to pay the rent. And then in 6 months, whatever the health issue is, obviously I'm just assuming here. But we get her health issue squared away, then we can talk about, when she's back to work full-time, we can talk about doing something for her.
Okay, thank you.
Well,
Another person I met at an open house, they own a property that was damaged from the earthquake, and they've never gotten paid on the insurance from the homeowner's insurance. So now they're in a short sale situation, and they want to buy something else.
mhm.
So that's another one of those.
Oh, yeah, as soon as the short sale's done, we can talk, especially with, under their circumstances. Again, short sale, 1 day out, I can go to 80%. And we'll have, hopefully we'll have enough equity to cover that. But that would be, yeah, that's a great one. So why are they short selling? They've just decided we can't get the house squared away, and the money's not coming through, and so did they stop paying the lender?
I'm not sure what.
Those are the questions, when we have an issue like that, certainly within the first year, depending on the circumstances, could be several years, we're gonna ask questions. And because the house had an issue because of the earthquake, that stinks. Why weren't they making their mortgage payment? Or were they making their mortgage payment, they bought in the top of the market and they're still in a poor equity position? Because the value of the house has gone down because of the issue with the.
That's what I think it is.
Interesting. Okay, but again, we can absolutely look at that one.
Thank you.
Would any of these programs apply to somebody who's not self-employed but are like a bartender?
Bartender's a W-2 borrower. They
Okay.
kind of get screwed. I'll tell you, another type, they do. It really stinks, because they're viable, they make good money too, but because they're W-2, they're not technically self-employed, they don't qualify for the bank statements. Waitresses the same way. House cleaners, we have to be able to verify that they are indeed self-employed. And oftentimes, house cleaners, it's all cash, checks, they don't need a license to clean your house. And they don't need to set up a business to do that either. Oftentimes, it's just word of mouth that they get their clients from. I'm not gonna be able to do that, borrower, because I cannot verify that they've been self-employed at least 2 years. A letter from their accountant isn't gonna cut it. I need a third-party verification. At the very least, I need a website to see. So those are questions I will ask, Jennifer will ask, about your clients. Got to be able to verify that you're self-employed at least 2 years. And if we're going business bank statements, that they own the business 100% for at least 2 years. Yes?
So you can't do the bank statement unless you absolutely have a self-employed situation?
Correct. Now, keep in mind that spouses who are W-2 absolutely fine to go on my loan. Use W-2 for the spouse, bank statements for the self-employed borrower. And if I can determine a primary wage earner, which I can in that instance, I'm going to use, my primary wage earner makes at least 51% of total monthly income. And let's say the self-employed guy works for Uber, which we do. And the wife works for the federal government. Uber, with his bank statements, makes $5,000. Federal government worker makes $7,500 and has a better score. That's my primary borrower, but I'm still using the bank statements for the Uber driver. But there's a lot of creative ways to get these deals done. I guess the one thing I want to leave with you guys is don't turn them away. Call Jennifer. These are very possibly very viable deals that in the past you guys didn't think were viable. I know we went through a mad crisis with programs that were in some reality quasi-similar, but today's requirements are way more difficult than they were back in the 2000s. These are viable deals and viable borrowers that can help you guys make more money. That's why we're all sitting here.
I have a question. So the 5-in-1 arm that you were talking about,
Mhm.
would it make sense for someone to buy that $600,000 property, do the 5-in-1 arm with the intent of selling it before the 5 years are up? Would they lose money then in all of the fees? Like, because that's a shorter amount of time for appreciation and all that?
That's an odd, if they want to buy a house and sell it in a few years, that's certainly their prerogative. There's no prepayment penalty on a primary residence. There is on my investment properties, by the way. For instance, that investor cash flow deal, that's a no income, no employment, 3-year prepayment penalty.
So I'm thinking the process behind that thought was, if you said, I'm gonna move every 5 years, and I wanna live in a big house, like your example, your payments on a 5-in-1 arm are less than on a 30-year conventional, right?
Sure.
So, couldn't a person or whatever just say, that's how I'm gonna live for the next 20 years, just move every 5 and have all that for less money? Or is that
Yeah,
like
wouldn't that be awesome?
skewed? What am I missing?
Not a thing. That's their prerogative.
But would that be a loss with all the
It's-
fees?
We'd have to see each time what the rates are at that point. Certainly transfer fees aren't cheap, but you split those in Maryland, right?
Yeah.
Yeah, so,
And the thing that I always tell people too is that if you were gonna rent that $600,000 house, you're probably paying $3,500 a month. Well, times that times 60, and how much money did you throw down the toilet for nothing? You got nothing, and you didn't own the property, you get no equity, you have no chance of getting equity, you're paying someone else's mortgage payment. So,
Right, but I'm thinking like if you didn't rent, if you had a house and then you traded up and then you traded, you know what I mean, every 5 years?
more power to you.
Like,
that's why I'm saying that it would be better to purchase than to rent for 5 years if you really look at how much money the rental would cost. A lot of people freaked out to me even when the equity went down and you were still even able to get out of your house without a short sale, but your equity went down. How
Right.
much would you have paid on rent that was nothing? I mean, it
Right.
just went to somebody else's equity.
Look, that circumstance was rare in terms of our economy and the history of our economy. More often than not, they'll gain some equity, right?
Great.
Every 3 years, you're not going to get a lot of equity, but you'll get some. And that in and of itself, based on your example, is a win-win for the borrower. Now, if they want to move every 3 years, have at it. Everybody, it works for everybody in this room. But I think that's probably a rare circumstance.
Right. Is there an owner-occupant requirement for a certain period of time on your non-investor loans?
I'm not quite sure what you're asking.
Well, if you buy it as an owner-occupant, then you
Oh,
decide a year later to
look,
rent it.
if they bought it as an owner-occupied property and they said on the application it's going to be owner-occupied, and a year later they decide I'm going to move and rent this place out, that's fine.
Okay.
Absolutely fine. That's their prerogative.
in Angel Oak, correct me if I'm wrong, if the customer is adamant about not having an arm,
Oh, yeah, we can go
There-
fixed rate.
there is fixed
And in fact, the
rates.
fixed rate's a quarter bump to my rate.
Yeah.
It's not significant, it's just, it's not typically worth the extra quarter you're paying per month on the mortgage payment. Because again, it's a short-term proposition, a couple years, 3 years. I mean, and most people don't stay in their loans 5 years, they stay in their house. But typically don't stay in their loan 5 years. It used to be 7, now it's down to 5, but we'll see what happens now that the rates are starting to creep up. But by and large, folks are gonna stay in their house a little longer. I mean, that's actually one of the problems with the inventory, right? Too many people are staying in their homes longer. People are aging in place and not moving to Florida anymore. That's one of the issues we fight with inventory. But yeah, all these things are options for you guys, and again, I can't reiterate that enough. These borrowers are viable, at least in some way. They're at least worth a look. Give Jennifer a phone call. Any other questions? If you don't have any now and you think of some later, you can ask Jennifer. Again, Jennifer and I have been working together now for about a year, right? And she's gotten to know what it is we do. If she can't answer your question, she'll call me and we'll have an answer for you quickly. I appreciate your time very much. Happy selling this spring, folks.
Thank
Good luck.
Yeah.
Yes.
And now you'll be